Market just likes to toy with us, doesn't it? It's like we had about as small a range and as low as volume as we could possibly get today. Not really following through with the bullishness from the last couple of days. Not really following through with the bearishness that we saw at the end of last week. So what is it? What kind of day or what kind of move are we leaning towards when we're just about as neutral as we can possibly be? So I'm going to break that down in today's video to see what having such a small range and volume can mean in this type of environment where that's not what we'd expect. We're also going to take a look at how what's performing this week so far in the first 3 days, what those clusters mean that we got yesterday, and at least one very close to one on the S&P 500, and how that can impact expectations going into end of the week and next week during a quote-unquote very unseasonal time of the year for the S&P 500. And then for our trade idea of the day, we're going to take a look again at another breakout stock like we did on Monday on the stock that's having its own breakout today and how we can trade that. So let's go ahead and get started. Today is Wednesday, June the 23rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator. As you can see, we remain in the upper reversal zone, the 81st percentile. We didn't quite get there yesterday. You notice yesterday we came about as close to an overbought cluster as you could possibly get, this being more of a bearish cluster because of the maturity of the intermediate run that we're on right now. Getting a cluster early on in the intermediate run is actually an overbought cluster. This is actually pretty bullish. But getting one when you're 8 months in, or nearly 8 months in, first of all, being 8 months in is extremely rare, and then to get a cluster that far along kind of shows just, again, how overbought we are. The last time we got a cluster here. Remember, the NASDAQ and the Russell started their own intermediate pullbacks. You can see here the NASDAQ had an intermediate pullback. The Russell kind of had an intermediate pullback, about as much as one you can get without actually being, breaking that 23%, significantly. So that's what started. That started with a cluster, a near cluster there. This one started an intermediate pullback for the NASDAQ in mid-February. There you can see this started this intermediate decline. So you can see when you get these clusters that are a long time in, they can start these intermediate exhales. Now they're a little bit more targeted on the exhales. This one appears to be coinciding with an exhale that's going on in the Dow Jones Industrial Average right now. So again, another targeted exhale. It's not quite a broader risk-off move where everything is falling. After really good strong days the last couple of days. Very, very small range today. In fact, if you look at the price moves, you can see basically we had 2 big days, and now we're back to just like nothing days. In fact, today's day was very, very minimal gap to the upside in the morning and a very minimal finish. So a very, very quiet day, and that's basically kept the posture where it's at. The near-term line still is up above 80. The intermediate posture still strongly bullish. Market sentiment still strongly bullish. Momentum line is down, but not to an extreme low or even an oversold low. So we're okay there. The Dow Jones, we're still in intermediate pullback mode. We're still in dark pink shading and red line mode. The near-term line is above 80, but only by a smidgen. We'll see how if it's if it rolls over. The momentum line is oversold again. The NASDAQ did get a cluster a couple days ago. Again, significant because it hasn't been getting clusters here recently over the last little bit, and now we're starting to get some again. And in fact, this is the first NASDAQ cluster we've had since this intermediate rally began way back over here. And then finally, the Russell 2000. Also, very, very small range, very minimal bounce. Yes, the near-term line is up strongly in the upper reversal zone, overbought territory. And yes, the intermediate line is declining, but it's still above 60, so it's still in bullish territory itself. Market sentiment, however, is not quite there. It's still kind of in neutral range, which makes sense because look how sideways we are. We've been in our options inventory trading class, which is what we do on Wednesdays. We've been killing it in the Russell 2000 this year, and most of the reason is because since the beginning of the year, it's been about as flat as a pancake. So that's how you do in that kind of situation there. So that's the kind of market forecast that we're getting. Again, strongly bullish, overbought, and then just kind of some mixed short-term sentiment here with bullish near-term sentiment, momentum line dropping just by a smidgen, looking like we might be, as of right now, holding some resistance in this area, some from these previous high points over here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here on the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Click on that as well as that bell next to it. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today and you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our videos. If you don't like our videos, of course, you don't have to click on anything. But if you do like our videos and you want to let us know, you can do that right now even with one click down there. Also comment, what did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, click on this icon right here, this on the Market Outlook Live. That's our live review video. I look at all the trades I've done and other Market Outlook videos. We manage them. In fact, we closed and rolled actually the Roku trade that we did in the previous Market Outlook just recently because it's been doing so well. I think I did that. We did that trade on Monday. So that one's been working out really well. We also put on today's trade idea before the market closes, so we did that already today in that video, and you can get to it also up here if you click on Market Outlook Live Trade Review. Come down here, here's all of our trading rooms that we have, our Q&A sessions, of course, for our premium subscribers, but all of our trading rooms and Market Outlook Live videos are available for all of our paid subscribers, including our monthly and our premium. Our premium subscribers, of course, get access to it for lower costs, but they also get access, in addition to that, premium subscribers get access to all of our tools and resources, as well as our class forums there. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Click on this thumbs up icon, opens up another new tab. Click on that like button. Again, the more you do that, the more engagements our posts have, the more people will actually see our content. That's how Twitter and Facebook work. That's why we always ask. We appreciate those who do click on it, the 21 people here, as well as the 91 people on Twitter. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, let's get back to the charts and let's take a look at how the weekly chart here is looking on the SPX. Again, the Hakinyashi differential is a really important indicator that we look at to see how big these candles are, and you can see it's just hovering. The green line's hovering right around zero. So very, very tight candles. No red arrow yet, so no pullback there. And a very, very high PPO. It's looking very similar to the type of year we saw in 2017, where we had very, very minimal declines here on the intermediate pullbacks. We had pretty much a whole year, 14 months or so of rally, of significant rally that culminated. The difference between now and then is that rally culminated with a parabolic peak with two little small declines, culminated with a peak that's actually lower than where we're currently at and where we have been for most of the year, right? Most of this year here, very, very strong. Again, you can compare one to the other because these are all normalized. This number is normalized by that long-term moving average. So in other words, obviously we have, we are have very strong, extremely high momentum, higher than that parabolic peak there, higher than we've seen in a while, basically since the 90s. And now we're starting to lose some momentum in terms of how big these weekly candles are. If you look at the three green arrows, of course, you have two green arrows, and MACD is almost positive. If you look at this, the stochastics, while giving you a green arrow, still is not above its moving average. The MACD also is not below zero, but it's also not below, it's still below its moving average too. So it's not quite out of the woods yet. Of course, the Qs look really good. They're both still above their moving averages, and looking, we're still diverging here on the MACD. So it's still very bullish. Diamonds, on the other hand, the opposite, right? We are negative. We hit the 8-day moving average as a resistance. We're rolling over. In fact, the Bollinger Bands show why we're stopping here on the diamonds. You can see that we are sitting at a very significantly strong resistance level. It's hard to get going to the upside. The Qs are up above their value area, so it'll be interesting to see how that holds out, because the spiders are not above their value area. That's kind of why it's still struggling to break away from this point of control that acts as a center of gravity, so to speak, on keeping it where it's at. Of course, the spider's still not in the directional move. Look at that ADX. It's about as low. It's almost to an extreme low here. So very, very significant low on that. Remember, the diamonds is the opposite too. It was at an extreme low and it's starting a bearish run. That's the question. Is that what we're going to do on the diamonds too? The Qs look really bullish, but still, relatively low ADX, so not as bullish. It's just kind of grinding. And then, of course, your IWM, no trend at all. Very, very noisy move. And you see that here on the trend strength indicator. Look at we've been noisy on IWM for a very, very long time. And we're noisy on the diamonds. And we're actually really noisy, too, on the SPY. So we're not really getting a trendy move here either. So really no bearish move. But no real bullish move either. We're not, we're holding this upper, this kind of upper fourth, this upper quartile. We can't quite get into that upper quartile. Again, low bandwidth on spiders. Diamond's a different story. We are floating with the lower quartile more so, and again with that upper band there. So it kind of gives you an idea of the type of move we're getting. Here's the RSI and the CCI. SPX kind of hitting some resistance here. The diamonds, the Dow Jones is in the lower half of its chart, and it's relatively bearish there. Of course, the NASDAQ 100 is a little different story. It's starting to diverge, actually, especially on that CCI. And then the Russell 2000 flirting with the top end and flirting with the lower half of its charts too, and showing a little bit more bearishness and not enough bullishness over the last couple of days to break that pattern. Enough to not get us, we're not free falling, so to speak, but not strong enough of a bounce to halt that sentiment, or to re-engage, at least to re-engage new strong bullish sentiment. All right, let's take a look at the intraday chart, and we can see here the move that the SPY, very, very small range, coming off of the highs at the end of the day, but nothing significant. We're already up a little bit in the after hours. The point of control is right there. There is no new high. We did get a breakout. We've been talking about this little bearish breakout. We didn't get all the way to 100, so not as bearish as it could be. So keep that in mind. You can see we're that close to getting another positive break, where the green line gets back up to 100. So, it's not as bad as it seems. The diamonds did, of course, get that breakout. You can see the Qs nowhere even close to it. And IWM also, we haven't got that yet there either. Now, we are getting close to the IWM making a similar type run that SPY did, because that's going to be the low point of tomorrow. But it just won't be like SPY. It won't be at 100. It'll be a bearish crossover, but not as bearish as it could be. Look at the volume really tapering off. In fact, when you look at the trading range and the volume, the trading range was 1.5 points. The volume was 49 million shares trading hands. If you take a look at that in context, of course, 1.5 points is extremely low. The volume, 49 million, is also relatively low. Again, we're coming up off a low point here. We're still below the moving average in the case of the diamonds. If you take a look at the diamonds, you can see, a very similar type pattern here. Let's look at the diamonds. Very low volume, 3 million. Very low, relative to the averages, of course. Very low trading range, 1.5 points. So let's take a look at that in context here. So here's diamonds. There's our 3 points again, very extremely low on the range. The volume, or 3 million was the volume. What was the range? Was 1.5 on diamonds, very extremely low. 1%, extremely low on the diamond. We're below the moving average. we're supposed to be getting the bigger moves. So it's a little concerning that we only got one bigger move, and now we've really tightened up, the declines there. If you take a look at the VIX for the S&P 500, we're not extremely low. We did break down over the last couple of days. We broke that 85% mark. We've broken into the lower half of this bullish territory for volatility, bullish for the markets, right, for risk appetite. When volatility is low, that's bullish for risk appetite. So we're not extremely low, but we are oversold. Volatility is oversold, and we'll see if we end up forming a low point here or not, or continuing to grind lower. Boy, if we break below 15, we've already broke below 20. That was an important breakdown from a bullish standpoint here in March. We've had a few little spurts above, but pretty much we're still below. We've been between 15 and 20. Breaking below 15 will be that next stage. If you take a look, when we've done this before, you've gotten up here, you've kind of stayed between 15 and 20. Once you broke 15, then that was a good bullish stage. Once you broke 15 here in 2019, you had a couple brief jumps, but you had a good bullish run going. Of course, breaking below 15 in 2016, you had a really good bullish run going there. So, and over here, so you might have brief jumps up above 15, but breaking below 15 is a significant change in risk appetite. Where it's kind of like, okay, we've established a long-term bullish trend, and we might have exhales, but nothing significant, and we can really get going again. And we're not quite there yet, but you can see how much closer we keep getting to that type of pattern. So to summarize the technical outlook, obviously we still got some persistent bullish posture going on, and we would have liked, after as down of a day that we had a few days ago, last week, it would have been nice to follow up with multiple strong bullish days, and then grinding down into small. We've really gotten down to extremely small bullish days rather quickly, and with the Dow Jones still below its moving average, that's not, again, your biggest down days and your biggest up days are below moving averages, and for it still be in exhale mode and already running out of bullish gas here, and makes you wonder how much steam we have left, and whether or not we'll get another one of those bigger bearish candles here in the next day or two. So just kind of keep an eye on that. That's my expectation again. Doesn't mean that we can't make bullish trades, as you saw with Roku, as you'll see with our trade idea of the day today. But it just means that how bullish am I, and how is that reflected in my trades, and can I protect myself while I'm still making these bullish trades? I mean, these are all things that we talk about in our trading rooms, and that's kind of the idea. So while nothing's ever so binary as I'm either all bullish or all bearish, obviously the market is still bullish, but it's not very bullish. And it's getting less and less bullish. And while there's still some good bullish opportunities on an individual basis, it's not such a broad bullish risk appetite. And it appears we're transitioning slowly to a broader, risk aversion trade. That risk aversion trade, which has been so narrow to large cap tech and small cap, and now very specifics, QQQ and Russell, a very, very small exhale in Russell, and then now the blue chip industrials. It's we've gone from one segment to the other without it being broad across everything at one time. Now the question is, will that be the case sooner rather than later? So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're a lot more bullish than I am, or whether you're a lot more bearish than I am, that things are going to be a lot worse than what an exhale might produce. All right, now let's talk about what's driving the price action. You can see over the last 3 months, it's still a very inflationary trade here. Weaker dollar. Bonds have been rallying. That's not as inflationary, but have commodities and real estate still as high as they are. Let's take a look at how things performed here this week to date, so including today, of course. I'll take a look at this here. You can see small caps have had a really good week, up 3% on the week. Commodities up 2%, the S&P less than 2%. Very strong week for risk appetite across the board. Qs there. On the other end of the spectrum, look at bonds dropping sharply. The dollar dropping quite a bit for the dollar, and then gold rallying because of the weakness in the dollar. Let's take a look at what some of these charts look like, especially for some of these different asset classes. So let's start off on the dollar. Remember, the dollar rallied so much. I mean, even with this little decline that it's had, if you take a look at it on this basis here, the euro US dollar, I mean, we're still below the 8-day moving average, even with today's move. So, I mean, we're definitely not necessarily bullish all of a sudden on the dollar. We're just bouncing from extreme oversold levels. The intermediate posture is still strongly bearish. We're well below the moving average. It's not going to turn even yellow anytime soon. And if you take a look at that 23% line of that long, so this orange 23% line, let me zoom out so you can see where it's coming from. So this bullish rally that we've had, that we had pulled back down to the 38% and bounced back above the 23% line, you notice that we had dropped back below it now. So on a long-term basis, we're not as, re-engaging a new bullish trend anymore. We're back below that, and we're back to potentially flirting with, and I think we're headed back towards at least 117.5, where there will be some pretty significant support between 117 and 117.5. I don't know how much more bearish we'll get. We've already hit it once here. I expect that we'll probably hit it there again, but not after some up and down moves, right, between here and there. You can see last time we kind of did the same thing. We broke down, then rallied a little bit up to that 23% line, just like we did right now, like we're doing now, and then rolled over and made that kind of a run. TLT has been on a bullish breakout itself, and you notice that all it's doing is it's kind of giving back some of that gain. I mean, we're still easily bullish, like we're still in bullish territory. We're still up above that 23% retracement that we had broken out above. We are back below the 38% line, but again, not like trend changing per se. The 10-year yield hasn't really broken that 23% level yet. So that's why I say, like, we're not in full exhale mode, though we are in, it is in bearish territory. The yield, the 10-year yield, is in bearish territory and not looking so good at all. Here's the 30-year yield, which looks a little bit different because it has kind of broken down below that level. If you take a look at the 23% line on this basis, it has broken below that. So the 10-year hasn't, but the 30-year did. So, and this is a little bit more, reflective of, remember the 10-year, the midterm is kind of influenced by the Fed, whereas the 30-year is more just economic expectations and inflation expectations. And you can see kind of how, we have broken down there, which I believe is more of a sign of risk aversion than anything else. So finally, gold. Let's take a look at gold too, and that's the breakdown gold's had because of the strength in the dollar. Let's look at the actual futures contract here. You can see that breakdown back to this 23% line. I believe they'll probably find some support here, even if the dollar rallies, and we're probably in that situation where the dollar and gold will both rally. If you look at the correlation between gold and the euro US dollar, which you would expect to be pretty similar. I look at the 63-day correlation of the euro US dollar, and let's bring this up so you can see a little bit better. Typically they kind of move hand in hand, but not all the time. And so, here's a situation where we can go negative. Here, let me show you some perspective on that. We can go negative on this correlation. There's zero right there. And that we can go negative when there's a bout of risk appetite. In other words, when the dollar and gold, or risk aversion, excuse me, when the dollar and gold move together. I kind of view that we might be headed towards that type of scenario here, where the dollar goes back up and gold holds this little layer of support that it's on, sitting on right now. All right, now we've been talking about the sector moves, and let's take a look at the sector moves. Here's the three, again, very inflationary. And let's take over the last 3 months, but let's look at this week just by itself, which has been kind of a risk-on week. On the other chart that we looked at with different asset classes, here is energy and there's financials, right? So discretionary also doing well. You can see very risk-on because utilities, staples, real estate, healthcare not doing as well. Those here are typical risk-off or safety sectors. And again, looking at the the 12 grid and you think, okay, if we're really bullish, they should all look dark green shading and green line. We do have dark green shading and green line on XLK with an overbought cluster no less. Same thing with XLC. XLY appears to be rolling, reversing and breaking out to the upside. These other sectors that had been so bullish, financials, industrials, materials, staples, utilities, none of this looks very bullish. That's not a sign of a bullish one. Dark pink shading and red lines across the board. Energy has an intermediate line that's falling. We might turn dark pink here pretty soon. Real estate is now not nearly as strongly bullish as it was. Healthcare still hanging in there, but just barely below 80. So it can turn light pink shading here pretty soon too. You've got some strength in these cyclical areas up here, but not so much in these others where the strength had been. Hence why I think there's a better margin of safety in the Qs than there is in the Russell 2000, which has been more correlated with these particular sectors, financials and industrials and materials, since they are such a big segment of the Russell 2000. Again, this is the S&P 500 sector, so it's not the Russell. These are not Russell 2000 stocks, but they are more correlated with the index because within the Russell, you have big allocations towards financials and industrials and these types of stocks. All right, so for our trade idea of the day, I want to take a look at a stock that's like Roku, kind of breaking out, and that's Tesla. Look at that nice little breakout pattern today. We broke out up above all these different highs from the past expiration cycle. Dark green shading a green line as the intermediate line crosses above 60. Don't have the greatest short-term sentiment. That would be better. It would look better if the near-term line is a little bit higher. The long-term charts, you can see the weekly, the candles looking better. Like that's a good bullish candlestick. We're back above that 50-day moving average with the exhale. Appears that it might be ending this exhale that we had been on. There's your 3 green arrows. You can see we do have the 8 and 17 day finally crossing above the 30. 30 days rolling up. The MACD is diverging as that blue line moves away from 0 to the upside. You can see here from a RSI standpoint and CCI standpoint, we have directional signals here. We're above 60, we're above 200. It's a good breakout type pattern there for that indicator. We're almost above 30, we're well below 20, so there's a little bit of a breakout pattern there as well. You can see the positive indicator hasn't been above 25 for a while, so it appears that we're finally breaking out with a very low ADX as well. Finally, look at the Bollinger Bands, and you say, okay, we're breaking above the value area, a little bit of a volume node there, and the value area, so we have an opportunity to kind of get going, but there's some volume above us too, so not a whole lot of directional opportunity here. So as a result, instead of necessarily doing a long call or a long call vertical spread, what we decided to do instead was to do a bull put spread. So we'll sell the 620, 615. When we did this, it was at a 30 delta. When we did it during the Market Outlook Live video. We have a trade on right now in our class portfolio, an iron condor spread, so keep that in mind. Or excuse me, a bear put spread from an old trade that's pretty much done now. But there's our bull put spread that we're doing for the Market Outlook category. And let's go to, we got to July expiration, and let's reset parameters here. So there's where we're at. There's where we got into it during the Market Outlook Live video. We're up a little bit here. That's why we have a little bit of a gain, about 12.5 bucks so far. Full position size, because I don't have to worry about earnings till after July expiration. And you can see that break even there is sitting right here. So essentially we'd have to, here, let me just make sure that that's the case. So let's slice the break even and set it to the chart. There we go. So right there, there's where the break even is. So we'd have to nullify this gap. We'd have to fill in that gap and then break down below 620, this volume node, for us to hit, this break even level, which would be right here, which at that point would be down today 285 bucks. I'm willing to lose 420. So even then, I've got some room below that to work with before I'd have to get out of this trade if it were to reverse this nice breakup. But that long candle is a great support. Like the bottom of that candle will act as a good support level. And support can be broken, but you expect support to hold until it doesn't. So that's kind of the idea behind how we're managing the risk on this particular trade. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Everybody has access to that, including our free subscribers. So open up any new thread with any questions or comments you have about what we discussed in the video tonight. Reply to other people's threads. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video down below. Remember to like us on Twitter and Facebook too. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.